What is XIRR? That is Extended Internal Rate of Return. That's what we are going to discuss today in the Market Secrets investment series. Before we get started, I have a request for you. In addition to the investment series, we have multiple other series on price action trading, algo trading, trading strategies, and taxation running in parallel. So if you are interested in any of it, check out our website for free learning. In addition to that, we provide multiple data feeds for our users. So if you are an active trader, you might find it useful. So all the details about the data feeds are also available in our website. So check it out if you are interested. Our website address is www.marketsecrets.in. And with that note, let's jump into today's session on XIRR. So what is XIRR? How can I use it to make the financial decisions? What affects XIRR in a good way and a bad way? Let's see it in detail. In the previous episode, we have covered CAGR and how it offers insights into point to point returns generated by mutual funds. But as mentioned earlier, this can be used to track returns of one time lump sum investment. In this chapter, we expand on this and measure the rate of growth of portfolios, which is generally created through SIPs. So, XARR, the full form is Extended Internal Rate of Return, is a generalized form of portfolio return measurement that takes into account both entry and exit transactions. So why do we call it as extended? IRR, internal rate of return, was developed as a measure, but it had some limiting underlying assumptions such as regular intervals between the transactions. We won't cover IRR here because XIRR is much broader and generalized. XIRR is the extended version of IRR that works for arbitrary set of dates. Most popular spreadsheet applications like MS Excel or Google Sheets have built-in XIRR formula. Just put equal to XIRR in the Excel formula and select the transactions, that is both inflow and outflow, and the date of the transactions. You will get the results. We call this as extended because it gives us the flexibility to include any date range. And now, why internal? Because it excludes external factors like asset class, risk, volatility, and includes only information that are internal to investors' portfolio, like dates of transaction, cash flow of each transaction on those dates, and final portfolio value if all investments are not fully redeemed. XARR is quite broadly applicable as long as one furnishes this internal information correctly. Before we gain deeper understanding of XARR, it would be better to see how we can use it in our day-to-day finances. So how to calculate XARR? First step in calculating the XARR is to enter the data properly. If the money is going away from you, then from your perspective, it is a negative cash flow and must be entered with a negative sign. For example, paying LIC premium or investing in a mutual fund SIP should be represented with a negative number. These amounts should be entered with a negative sign to denote negative cash flow along with the date of the investment. If the money is coming towards you or has the potential to come back to you, it is a positive cash flow. Your bank deposit maturity amount or your stock portfolio latest valuation or redemption amount, etc., should be entered with a positive sign in your spreadsheet in the context of XIRR calculation along with the dates of redemption. So let's see a simple representation. So if you look at here, so this is my transaction summary. So I have been investing every year. So I'm investing 1 lakh rupees every year for the first 20 years. If you look at here, all these are represented in negative numbers. After 20 years, I need to wait for 5 years, and from the 6th year onwards, I'll be getting 4 lakh rupees return every year. So if you look at here, I'm getting 4 lakhs rupees return every year for the next 10 years. So this needs to be represented with a positive sign. So this is how you need to enter the data, and once that is done, if you use the XIRR built-in formula in the Excel or spreadsheet, you will be able to get the XIRR value. You need to mention the date and also the amount. So both the ranges you need to mention in the formula, and you'll get the XIRR results. So in summary, you will be investing 20 lakh rupees and you'll be getting 40 lakh rupees in return. This amount of 40 lakh would look so big in the hindsight, but if we look at the actual XIRR returns, it is merely 3.45% over 25-year period. Now let's play with the numbers and just tweak this data a little bit. So if you look at this particular data, right, instead of waiting for 5 years after the completion of premium payment, if you start receiving the funds immediately after the premium payment, right, then in that case, right, your XIRR will jump to 4.55%. So here the amounts are still the same. For example, right, if you look at here, we are investing 1 lakh rupees for every year for 20 years. So your investment will be 2 lakh rupees and you're getting 4 lakh rupees every year for 10 years. But instead of waiting for 5 years after your premium payment completion, you're getting the payout immediately. So in that case, right, your XIRR jumps. So, if we are moving the payout ahead of the original schedule, this has an effect on XIRR. It improves your returns. Likewise, if we delay the premium payment by splitting the monthly payment and pay 25K per quarter, then in our case, XIRR will improve as well because of the delayed negative cash flow. So, in addition to the returns, XIRR can be used to capture the time value of money, which is one of the very important metric when it comes to investing. We will discuss about this in detail in the next session. But if you talk about XIRR, it rewards these two factors. Number one, earlier receipt or withdrawal of the higher value from an investment. Number two, delayed negative cash flow or investment to achieve the same financial payout values. So if you invest more later to achieve same final redeemable portfolio value, XIRR value for that set of transaction history would be higher. Corresponding reverse scenarios would result in lower XIRR values. So it is highly instructive to calculate potential XIRR of an investment by listing cash flows at different periods before embarking on it. This would give you a better objective measure on how good or bad this investment could be in comparison to other valuable options whose XIRR has already been computed. So in simple terms, before you make any investment, you can calculate the outflows of your investment and also the expected returns at the end of the time period of your investment and put all these in the Excel sheet using the proper dates and the proper numbers and use the XIRR formula to calculate the actual return on your investment. This way you would know exactly what you're getting into. This will take maximum of 2 or 5 minutes, but 95% of people won't do it and end up paying for this financially by getting the lower returns. So don't make this mistake. Just 2 or 3 minutes of your time and you will know exactly what you're getting into. So don't ignore the power of this XIRR calculation. So with that, we have come to end of today's episode. So I hope this was useful for you. If you have any queries, comments, or feedback about this episode, please leave it down in the comment section. We'll be happy to answer it. Also hit the like button if you like this video and share it with your friends if you find it useful. Also your feedback is important for us, so please do leave a comment if you find this video useful. Also subscribe to our YouTube channel and click the bell icon to get notified whenever we upload a new video or conduct a live session. Thanks for watching. Have a great day. Goodbye.